Most people think a higher credit limit means they have more money, but that is exactly the mindset that turns a useful financial tool into a trap. A credit limit is not extra income, it is not permission to upgrade your lifestyle, and it is not a reward you are supposed to spend. It is simply the maximum amount the bank is willing to let you borrow, and if you treat that number like your own money, the bank has already won. This matters even more when you get your first large credit limit, whether it is $5,000, $10,000, $20,000, or more. The number feels exciting because it looks like trust. It feels like progress. It feels like proof that your credit is improving. And in some ways, it can be a good sign. A higher limit can help your credit utilization, give you flexibility for planned purchases, and make your credit profile stronger if you use it responsibly. But the benefit comes from having access to the limit, not from using the limit. That difference is everything. If you have a $10,000 credit limit and you normally spend $500, your utilization stays low and your system looks controlled. If you have the same $10,000 limit and suddenly spend $8,000 because the room is there, your risk is much higher. The limit did not make you richer. It only made it easier to borrow more before feeling the pain. The first rule of high credit limits is simple. Never let the limit decide your spending. Your budget decides your spending. Your cash flow decides your spending. Your real bank account decides your spending. The credit limit is just a ceiling, and a ceiling is not a goal. You do not walk into a room and try to touch the ceiling just because it exists. You live comfortably below it. Credit cards work the same way. A strong credit card user does not ask, "How much can I spend?" A strong credit card user asks, "How much can I pay in full without stress?" The bank answers the first question. Your financial life answers the second one. Credit utilization is one reason higher limits can be useful. Utilization is the percentage of available credit you are using, and it can affect your credit score because it gives lenders a snapshot of how much revolving debt you have compared with your limits. If you have a $1,000 limit and a $500 balance reports, that is 50% utilization. If you have a $10,000 limit and the same $500 balance reports, that is only 5% utilization. Same spending, same payment habit, very different credit report snapshot. That is the good side of a higher limit. It gives your normal spending more room, so your reported utilization can stay lower. But the benefit only works if your spending stays the same. If your limit goes up and your spending rises with it, you did not improve your system. You expanded the trap. A high credit limit is neutral. Your behavior decides whether it becomes protection or pressure. If you pay in full every month, track spending, and use credit cards as payment tools, a higher limit can help you. If you see available credit as available money, a higher limit can hurt you. Be honest about which type of user you are. There is no shame in keeping limits lower if that helps you stay disciplined. The best financial strategy is not the one that looks impressive. It is the one you can actually control. Another mistake is confusing available credit with emergency savings. A credit card can help in an emergency, but it is not the same as an emergency fund. If your car breaks down, a medical bill arrives, or your paycheck is delayed, a card can give short-term flexibility. But if you do not have cash to pay the bill, the emergency becomes credit card debt. An emergency fund absorbs emergencies. A credit card delays them. Delay can be useful, but delay is not the same as protection. The stronger strategy is to build cash savings first, then use credit cards for convenience, rewards, protections, and timing. A high limit should sit on top of financial stability. It should not replace financial stability. If your only emergency plan is a credit card, you are one crisis away from paying interest. And once interest starts, rewards usually stop mattering. A 2% cashback card cannot beat high-interest debt. A travel point strategy cannot save a budget that is leaking through revolving balances. So when your limit increases, do not celebrate by spending more. Celebrate by keeping the same spending and letting your utilization improve. Another important rule is to separate planned large purchases from impulse large purchases. A high limit can be helpful when you have a planned expense like a laptop, insurance premium, medical bill, travel booking, home repair, tuition payment, or business expense. If the money is already available and the purchase was already planned, putting it on a credit card can earn rewards, provide protections, and keep records clean. But a high limit becomes dangerous when it turns a maybe into a yes. Maybe I should upgrade the flight. Maybe I should buy the nicer phone. Maybe I should replace the furniture now. Maybe I should book the trip because the card can handle it. That is the moment to slow down. The card can handle it does not mean your budget can handle it. The bank approving the transaction does not mean the purchase is wise. The real question is, Would I still buy this if I had to pay cash today? If the answer is no, the credit limit is influencing the decision. And when the limit starts making decisions, the system is no longer yours. This matters even more with rewards. A high limit can make it easier to chase welcome bonuses because you have more room for spending, but the rule does not change. Meet bonuses only with spending you already planned and only with money you already have. Do not let a large limit make a large spending requirement feel harmless. A welcome bonus is valuable only if the spending is normal and the balance is paid in full. If you carry the balance, the bonus can disappear into interest. If you buy unnecessary things, the bonus becomes a discount on overspending. If you stretch cash flow, the bonus creates stress. The rewards game is not about using as much credit as possible. It is about routing normal spending through the right tools. A high limit gives you more routing capacity, not more income. Your total available credit across all cards also matters. If you have 3 cards with $3,000 limits, your total limit is $9,000. If your reported balances total $900, your overall utilization is 10%. This is why some people request credit limit increases on cards they manage well. More available credit can make normal balances look smaller as a percentage. But again, the benefit only exists if balances stay controlled. Before requesting a limit increase, ask yourself 3 questions. Do I pay in full every month? Do I want the increase for utilization and flexibility, or because I need to spend more than I can afford? Will a higher limit tempt me to carry a bigger balance? If the answers are strong, a credit limit increase may be useful. If the answers are uncomfortable, fix the system first. Credit limit increases are best for people who do not need them. That may sound strange, but it is true. If you need more credit because your spending is already too close to your limit, the real issue may be cash flow or budget pressure. If you want more credit because your normal spending reports too high and you pay in full, that is a healthier reason. The same action can be smart or risky depending on the reason behind it. Another risk is that high limits can make spending feel less visible. A $500 purchase on a $1,000 limit feels huge. The same purchase on a $20,000 limit feels small. But it is still $500. Your bank account feels the same cost. This is why you should track spending in dollars, not only percentages. Low utilization is good, but low utilization does not automatically mean low spending. Someone can have low utilization and still spend too much for their income. If your limit is high, your utilization may look beautiful, while your budget is quietly strained. Do not let a strong credit profile hide weak cash flow. Credit score health and financial health are related, but they are not the same thing. You can have a good score and still be overspending. You can have high limits and still be one emergency away from debt. You can earn rewards and still be losing money. The numbers that matter most are income, expenses, savings, debt, and the ability to pay in full. A useful habit is to create a personal spending limit that is far lower than the bank's limit. Your card may have a $10,000 limit, but your personal monthly limit might be $1,000 because that is what fits your budget. That personal number is the real limit. You can set alerts when your balance reaches a certain amount. You can check your card weekly. You can pay it down every payday. You can use a budget app or a simple spreadsheet. The method matters less than the boundary. The bank gives you a credit limit to manage its risk. You need a personal limit to manage your risk. The bank's limit protects the bank. Your limit protects you. This is also helpful before important credit applications. If you are applying for a mortgage, car loan, apartment, business credit, or a new credit card, you may want reported balances to stay low before a lender checks your credit. That can mean paying balances down before statement closing dates for 1 or 2 cycles. A high limit helps because it lowers the percentage, but timing still matters. If an important application is coming, keep things boring. Low balances, no missed payments, no unnecessary new accounts, no risky changes. A high credit limit is useful, but a clean credit report is better. Some people ask whether they should accept automatic credit limit increases. If you pay in full and control spending, an automatic increase can be helpful because it improves available credit without extra effort. But if a higher limit tempts you, you can ask the issuer to lower it or simply avoid requesting more. More credit is better only when more credit does not change your behavior. Another thing to remember is that credit limits can change. Banks can lower limits, especially if they see risk, inactivity, high balances, missed payments, or broader economic stress. Do not build a financial plan that depends completely on a credit limit staying high forever. If the bank lowers your limit while you have a balance, your utilization can spike. If you were relying on that available credit for emergencies, the safety net can disappear. Your emergency fund is under your control. Your credit limit belongs to the bank. That is why cash savings matter. Another common mistake is using high limits to hide lifestyle creep. Lifestyle creep usually does not feel dramatic. It feels like small upgrades that seem reasonable because the card has room. More dining out, nicer hotels, more subscriptions, better seats, new devices, extra shopping. You may still pay in full, so it does not feel like debt, but your savings rate may shrink and your goals may slow down. Paying in full is necessary, but it is not always sufficient. You can pay in full and still spend too much. The deeper rule is to spend intentionally. A high limit should not make your lifestyle expand by accident. It should give your existing lifestyle more breathing room. One way to stay grounded is to review your card like a cash account. At the end of each week, ask, if this balance were already gone from my checking account, would I feel comfortable? If the answer is yes, you are probably managing well. If the answer is no, you may be using the card to delay reality. Credit cards separate buying from paying, and high limits make that separation easier to ignore. Weekly reviews reconnect them. Another important idea is that a high credit limit gives you capacity, not obligation. You do not have to use it. Unused credit is not wasted. In fact, the most valuable part of a high limit may be the part you never touch. That unused room keeps utilization low, gives you flexibility, and shows lenders you can handle access without abusing it. The goal is not to use the limit. The goal is to manage the limit. There is no perfect credit limit number. The right limit depends on your income, spending, comfort, discipline, and goals. A useful limit is high enough that normal monthly spending does not create high utilization, but not so high that it tempts behavior you cannot control. For some people, that is a few $1,000s. For others, it is much more. The number matters less than your relationship with it. Personal finance is not only math, it is behavior repeated over time. So if you get your first high credit limit, do 10 things. Do not change your lifestyle. Set a personal spending limit below the bank limit. Turn on alerts. Pay the full statement balance every month. Consider paying before the statement closing date if utilization matters. Use the card for planned purchases, not emotional purchases. Keep building cash savings. Track total spending across all cards. Use rewards only on spending that already makes sense. And remember that unused credit is not wasted. If you follow those rules, a high credit limit can help you. It can lower utilization, improve flexibility, support rewards, and strengthen your credit profile. If you ignore those rules, the same limit can hurt you. It can normalize bigger balances, hide overspending, encourage lifestyle creep, and turn convenience into debt. The difference is not the limit. The difference is the user. Credit cards are not dangerous because they have limits. They become dangerous when people forget that the limit belongs to the bank and the bill belongs to them. The bank gives you room. You provide discipline. The bank gives you rewards. You provide payment. The bank gives you a number. You decide whether that number changes your behavior. That is the real test. So the next time your credit limit increases, do not ask, "What can I buy now?" Ask, "How can this make my system safer? Can it lower my utilization? Can it give me flexibility without changing my budget? Can it support planned purchases without creating stress? Can it help my credit profile while I keep spending the same?" If the answer is yes, the limit is working for you. If the answer is no, the limit may be working on you. The smartest credit card users understand that power is not using every dollar available. Power is having access and choosing restraint. Power is seeing a high limit and still following your budget. Power is earning rewards without carrying debt. Power is keeping utilization low without pretending available credit is income. The best part of a high credit limit may be the part you never use. That is how you turn it from temptation into a tool. And that is how you build credit without building debt.